And today, Mike, you and I are going to share the setup of what we call the radioactive profit machine and some risk-free spreads that can be done within the context of a radioactive profit machine.
Indeed.
And we're going to see, we're going to see a recently closed trade. It's not the most spectacular. I choose it because it's a little more modest. I mean, your most recently closed radioactive trade resulted in a 59.8% gain. And a lot of folks didn't do that well this year.
Right. Unfortunately, but we would like to see...
or last year, I should say.
Right.
More and more, yeah. We'd like to see more and more folks do well. Mike, I'm going to go ahead and share these results because you can choose more than one from the selection. The total is more than 100%, right? So 34% are taking advantage of the free materials. Guys, why isn't that 100%? Let's make it that way, okay? I would like to point you out to the free tools on RadioActiveTrading.com and encourage you to try them out. There's also a link that can get you a free 2-week subscription to Power Options so that if you're interested in trading the radioactive strategy or any other strategy that you're already using, Power Options supports that, and you can get 2 free weeks from the site. 31% are thinking about buying the blueprint. Great. I think you're going to be pleased with today's presentation. And 45% of our audience, Mike, already own the blueprint. That's marvelous. I'm excited to have them here, and we're going to move forward. I'm going to ask what kinds of options trades we're doing now. For example, usually the highest scored the highest scored category out of the categories I've got listed here is covered calls. And I would call that the gateway drug. You know, that's the that's the first strategy that most folks learn on how to trade options or mix options with stock. But recently we've had spread trades beat that. We've had sometimes more spread traders than covered callers on the line. Today it looks like we've got a number of folks that are not happy with options. I'm going to say that if you answered options me no likey, there's really only 2 reasons why a trader would not like options. The first is that you just don't understand them, and so therefore shy away from them and mistrust them. And the second reason is perhaps you've traded options and gotten burned. Well, I'm going to say that the cure to both of those ailments is education, and we offer free education here at on these webinars, and hopefully it'll help you understand that options can actually take the risk out of trading, at least the riskiest parts, and in some cases eliminate all risk from your trades if you're doing them a certain way, if you're doing them correctly. Okay, Mike, I'm going to go ahead and close that poll and share the results. 7% did say options me no likey. Hopefully today we'll get them a little closer to liking options. 61% are covered callers, so that's marvelous. I think you're going to be pleased, covered callers, with what I have to share with you today, because it was the missing part to trading that I really needed back in the late 90s. And because I didn't have this missing piece, I got hurt. I'm going to go ahead and share something with you today that I think will change your picture. 50% do long calls and or puts and naked puts, which is the same as a covered call trade in terms of risk and capital that you should have on hand. And 57% are doing spreads and contours, so that's the second place today, but it's a really close second. Folks, I'm going to ask you a question. This isn't a poll, okay? Just maybe use your text box there. Would you be interested in seeing 2 spread trades that have 0 risk? And one of those trades, in fact, is done after the market makes a move rather than before it makes a move, so that it's reacting to what the market has done instead of what we imagine it may do. Would you like to see that? Would you like to see 2 risk-free spread trades? And looks like a couple of folks would. Joe would like to. Tim would like to. John and definitely says BK. Dan's into it. Walt is into it. Oh, Walt says options scare me. Okay, Walt, we're going to do our very best to help you feel more comfortable. Okay, so Ron has said yes. You know what? We're going to go ahead and go into this. Now, folks, I'm going to, Mike, did I take down the poll yet or no?
No, sir, the poll's still up.
How about now?
Very good.
Okay,
We're
how
ready
about
to
now?
go.
Is that better?
Yes, sir.
All right, the way to get most out of today, folks, is to hold your questions to the end. Jot down your question if you have a question, because it's very likely that Mike and I have already anticipated your questions since we've been doing this presentation or a variation of it for a number of repetitions. So hold your questions. If we don't get to your question, and we are going to have a place to pause for questions. If we don't get to your question, we'll answer it by email, but we should be able to handle everybody's questions. I just don't want you to distract Mike right now or me, but rather just kind of get in receiving mode, okay, for a little bit. And if you'll participate in the polls and the prompts, some of those polls and prompts will help Mike and I to guide the presentation, but some of them are going to be a lesson in themselves, okay? All right, folks, I'm going to make you a bold promise, and the bold promise is that I'm going to show you a simple truth that all successful traders use. Okay, they may not do it the same way that I do, but all successful traders use this simple truth. Okay, here's a saying, and I want you to finish the saying if you've heard it. Okay, because most folks have heard this. All right, cut your losers short, and then what's the rest of the saying?
I'm not going to answer it.
Text in there, folks. Cut. Yeah, I know you're not. I want somebody from our audience. We've got 5 dozen. Hey, there it is. Ronald said, "Let your winners run." Okay, let your winners run, says John. All right, very good. We've got some folks that have heard this before. Cut your losers short and let your winners run. Okay. Now I got a question. Do we always do this? What if you could guarantee that you always would do this? I mean, what if you set up a trade from the beginning so that if it was a winner, it would be allowed to run, but if it was a loser, the losses would be cut very short? Would that be valuable? I think so. Here's the promise, folks. I'm going to show you a practical way to put this principle to work. Ron says, magic. It will instantly improve your trading results, and if you don't believe that, we're going to run a poll here and do a before and after, okay? Like before you had this information and after you had this information.
Mm-hmm.
I've had folks, Mike, and so have you, I've had folks approach me and say, look, you know, I went to an options trading seminar. It was a weekend, and it cost me over $3,000. Much more than that when you count travel expenses and so forth. And what you taught me in this free seminar, this free webinars, was more valuable. I've had folks say that, and we do this for free.
Mm-hmm.
Okay? All right, so here's my challenge, okay? I'm going to say that this will transform your trading results if you apply it, okay? I'm giving it away for free, but in return I'm going to ask for something for you. At the end of the webinar, I'm going to be making a special offer for some products and services that will further enhance your trading, okay? I don't want anyone to invest in a program unless I fulfill the promise to you to show you how to instantly improve your trading results, okay?
Mm-hmm.
But if I do fulfill that promise, I want you to think of us first when it comes to expanding your education on options trading. Is that fair enough? So let's just hear a couple of answers, okay? Do y'all think that that's fair enough? That if I show you how to instantly improve your trading results, that you'd probably think of us first when it comes to expanding your options trading education. I'm not going to go until I hear some replies. Okay, Walt says fair enough. We've got over 5 dozen folks on the line, but I'm seeing a lot of the same people answering. So, okay, John says yes. Very good. Okay, Joe's into it. All right, very good. All right. And John says it's fair enough, but I already own the blueprints. Okay, well, John, you know what? We do have some things that can enhance what you already know from the blueprint and take it a little bit further, but it's certainly not required. If you own the blueprint, you've got all the tools. Okay. Okay. Well, let's go forward. I'm glad that John is here. Let's review the saying. The saying is cut your losers short and let your winners run, right?
Mm-hmm.
Mike, does this saying go along with the strategy of selling covered calls or selling naked puts?
No, it's sort of the opposite, isn't it, Kurt?
Yeah. Yeah, when you sell a covered call, you pretty much agree to take a certain price for your stock, no matter how high it runs up. You've kind of obligated yourself. For example, if you sell a $60 call option and your stock goes to 80, well, you don't get to really participate in that upside, do you?
No, not at all. You've capped your gains.
Yep. Yeah.
Mm-hmm.
How about for our spread traders? Certainly we do have a limited risk when we start out. Okay, so we are cutting our losers short, for example, when we do a spread trade. We do put a limit to how much we can lose with most types of spreads. On the other hand, do they allow the winners to run? Yes or no?
No, our gain is still capped, just as it is with a covered call or naked put to begin with.
All right, very good. Okay, so we had somebody write in. I'm going to ask you all again to hold your questions, okay? But Dan wrote in, when is your $3,000 weekend seminar? Hey, we're doing it now. It's free. We don't charge $3,000 for a seminar, okay? But the value that you're going to get out of this, I'm going to prove that most of you will get a value out of this greater than that, okay? We'll find that out later on. Now, Mike, limiting your gains while leaving yourself open to losses does seem kind of backwards, doesn't it? I mean, the covered call strategy is a bullish strategy in that the biggest component of it is ownership of stock. Mm-hmm. Now, it's billed as being safer, and this isn't my graphic, okay? I took this off of a broker's site. It is billed as being safer, and it certainly is kind of understandable. I mean, it's really, you're really quick to pick it up if you've got college education or, you know, have some facility with numbers. I mean, this is really doable, all right? But, Mike, it's kind of backwards, isn't it?
Mm-hmm.
I mean, the thing is, we have a limited reward and almost unlimited risk. What's the biggest complaint that you've gotten from folks that do the covered call trading strategy? I know that Power Options supports 23 different strategies, and covered calls is one of them. Mm-hmm. What's the biggest complaint that, as the director of education over there, that you've heard?
Well, over the long time horizon, if you're using just covered calls as an investment technique, then what ends up happening is that the strategy works as a sorting machine in your account. If you selected the right stocks that move up 7, 8, maybe 10% over an expiration period, well, you've capped your gains, and you have to pay more money if you want to try to manage it or get advantage of the higher gains. But meanwhile, all the stocks that dropped 10, 15, or 20% are still in your account, and you're trying to manage them with lower premium options or trying to adjust down the strike price and risk getting called out for a loss. So it's a sorting machine. The winners get called away from you, and the losers stay with you.
Right. I can't tell you how often I've heard somebody say something like this. They said, man, I was in Amazon, and I sold a covered call, and I made 5%, but it went up 100%. Mm-hmm. You know, that happens more often than not, is that you end up trading stocks that have great potential, but you don't get to exercise that potential. You don't get to let your winners run. Okay? So I got this crazy idea, Mike. My idea was to flip that hockey stick upside down, which actually is right side up because it was kitty wampus to start with. Mm-hmm. Okay? Now we still have a bullish strategy. Covered calls was bullish, and protected put is bullish because it mixes ownership of stock, which is bullish, with a bearish option strategy. Bearish option strategy is owning the put or selling a call. Well, if we, instead of adding a short call, if we add a long put, do we have better protection, yes or no?
Well, yes, we do. We've floored the protection. We have a guaranteed limited risk where we can't lose more than that basis, the difference between the strike price of the put and our initial net debit.
That's right. You see, by buying a put option to secure ourselves in case our stock goes down, we put a floor on what we could possibly lose. On the other hand, the upside is unlimited. Ron writes in, so sell puts. Ron, you're missing the point. Selling a put is the exact same, it's called a parity trade, it's the exact same risk-reward profile as selling a covered call. It's the same thing. Okay?
Mm-hmm.
So buying stock and also buying puts to protect those stocks is the best way to go. Okay? All right, very good. Let's see, Mike, I'm going to go ahead and move forward. In 1999, I had gone broke by mixing options and stock the wrong way. But by October 2002, I began to mix them the right way, and that was to use options to limit my possible losses. After building up some capital, I bought Yahoo and eBay and Amazon and others at reasonable prices, and they went up. Now, the thing is, if I had sold covered calls on them, then I would have felt like a chump. For example, with Amazon, I bought Amazon at $16.09, and I bought a $20 put option way far out in time.
Mm-hmm.
Over the next 13 months, while it was still covered, Amazon went to over $60 a share. From $16.09 to over $60 a share. I would have felt like a chump if I'd have sold in 17.50s, wouldn't I?
Absolutely.
If I'd have sold $17.50, $17.50 calls, I would have been obliged to take the $17.50 instead of take the gains on a 200% gainer. Okay, so I blogged about this. Soon people were asking me, "Hey, have you written a book?" And I said, "You know what? You buy it, I'll write it." And that's really how Radioactive Trading and the Blueprint were born. Okay. Now, I had been giving things away for free. I had just been telling folks what I was doing, and I learned really early on that if you give things a great value away for free, amazing things happen, just like with Google. Google's one of the biggest companies in the world, right?
Mm-hmm.
But to you and me, their service is free. They give away something of value for free. So I'm going to give away the general strategy for free right now, and the Blueprint, of course, is an expanded version. Okay, there's been more than $500,000 in sales of the Blueprint and associated services, but I still believe that it makes sense to give the value first. Okay, all right. Now, just before we go into the Radioactive Profit Machines schedule, I'm going to ask, what would you rather do? Okay, this is an options leverage question. Okay, what would you rather do? If you're going to lose and then earn and then lose again, would you rather lose 5%, make 20%, and then lose 5% again? Or would you rather be leveraged with options? And, for example, in the same trade, lose 40%, then make 160%, and lose 40% again. Now, don't break out your calculator. I just want you to give me off the cuff. Which of these columns would you rather choose, left or right? Left or right? Would you rather, if you had to lose twice and win once, would you rather lose 5%, make 20, and then lose 5% again, which looks like a net of 10 gain? Or would you rather go to the right side? Walt says it's the same. Okay. Would you rather multiply them all times 8? Lose 40%, make 160%, which is more than doubling your money, and then lose 40% again. Okay? You got a lot of folks saying left. Anybody saying right? Walt is saying it's the same. Okay. Well, let's see if that's so. Here's the math. All right. If you were to lose 5%, then gain 20% on what you have left, and then lose 5% on your result after that, your net gain is going to be 8.3%. You can go ahead and check me on that. On the other hand, if we were leveraged and we had a 40% loss, 160% gain, and 40% loss, we'd have a net loss. You see, the more leverage you have, the worse it gets when you have losses at all. Okay? So let's multiply times 10, a 50% loss and a 200% gain, tripling your money, and then another 50% loss would equal a more than 25% net loss. Okay? Why is this important? Well, it's important because using options correctly, we can take our possible losses down into single-digit percents. But if we do it incorrectly, we can leverage ourselves out of profitability. Okay? So, Walt, you're going to need to do some math there, sir.
Well, you have
Is the leverage from trading long calls and puts really a better way to go? Go ahead.
Oh, I was going to say, you have a slide after this that shows the math of the 525, right? You have a slide that right after this that shows the monetary value of the 520 and 5, so we can show how that works, how it's not 50%.
Walt said, yeah, it'll be a little bit later on. It'll be a little bit later on that slide comes. The lie of leverage, okay, is a lot of times when folks say, hey, if you use leverage, you can make lots and lots of money. Well, yeah, sure, but if you use leverage, you can also get hurt. I don't use leverage. I use options for something completely different. I use it for an insurance policy. Okay? All right. So we're going to learn how to turn this upside down and take the risk turned upside down. My day job, which I do at night, you know what my day job is, right?
Mm-hmm.
Okay. I teach mixed martial arts. I've been doing it since 1986, and so now I'm in my 40s. And I don't get in the ring anymore, but I do teach folks to get in the ring. And I'll tell you what, when somebody comes in off the street, I'm 160 pounds soaking wet, okay? Somebody comes in off the street and they're 220 and they're 18 years old and they've got a bunch of fire in their eyes. I'm not fearful at all because I understand some principles of leverage that makes them more than an uneven match to the good for me, okay? On the other hand, once that fellow's been in my program for a couple of years, I'm not going to tangle with him anymore. You know why? Because he's a big boy, and he's youthful, and he knows all the same principles of leverage that I do. Okay? So so here's the thing. If you're going to use leverage, you got to understand that leverage can be used against you too. Okay? All right, so let's get into it. We're going to get into the RPM structure, the radioactive profit machine, but I'd like to first do a really interesting exercise in probability and statistics, okay? I want you to be careful because I might just reveal to you how you're going to beat the market in 2011. Now, just before we do this exercise, let's do a quick poll here, Mike, about how folks did in 2010, okay?
Mm-hmm.
Are you happy, folks, with your trading results from the last 12 months? Are you happy, real simple question, with your trading results from the last 12 months? Yes, no, or mixed emotions? We've had 29 people join us since our last poll question, Mike.
Mm-hmm.
So this might be a little bit different answer. Let's give it another 15 seconds. Can you hear me okay, Mike? Because where I am, there's a bit of background noise. All right?
I don't think that's the problem. I think part of the problem right now is the bandwidth on GoToMeeting because I'm getting the sensation that my replies and retorts to you are being, I don't want to say retorts, but my replies to your questions and your prompts are severely delayed when you receive them from when I'm speaking. But other than that, the sound has glitched one or two times, but I think it's still all right overall. And we do apologize for that, but I think it's definitely the bandwidth on the platform we're using, the GoToMeeting platform.
That's because of all the people we got on the line, huh? Could be. Folks, this was the results of our poll. With 79 people in the room, we've got 18% saying, yes, I'm happy with my trading results. 55% saying no, I'm not happy. 27% saying mixed emotions, and that's out of the folks that participated. I guess we didn't have 100% participation, but out of the folks that participated in the poll, 18% said yes. 55% said no. 27% said mixed emotions. Folks, I'm going to say that that's not good. That's not good. But it works out about the same as what we've seen here, Mike, isn't it?
Mm-hmm.
I mean, that 80-20 rule is in effect, where 20% seem to be successful and the other 80% don't enjoy the same success. I'm going to congratulate all three groups, though. First of all, the yeses. One of the reasons that you're in the yes category is that you take advantage of things like this to increase your knowledge. And the other groups, I'm going to congratulate too. The folks that said no, and the folks that said mixed emotions. You recognize that there's a problem, and you're here to do something about it. All right. Congratulations. We're going to show you. Right? All right. Mike, let's reveal how everybody is going to beat the market in 2011.
Okay.
And we're going to look at this trade simulator tool on the resources tab. This is another free tool at radioactivetrading.com. And let's go to resources. Right up here at the top, Mike, you'll be happy about this. There's a link to Power Options to try a 2-week trial for free. And none of that capture your credit card information and we'll bill you. None of that nonsense. It's you just supply your name and they'll give you 2 free weeks of Power Options. But let's go here to the Trade Simulator tool. Okay, the Trade Simulator tool will give us an example of what our account is going to look like after 100 trades, and we're going to look at this principle of leverage and how to beat it, how to beat the leverage effect against your stuff. Okay? All right, Mike, what we're looking at here is a tool that will, it does a feature, does it? What it does do is calculate if you had a certain target return and a certain loss limit, and these were the rules that you used to trade with, and also a certain probability of success. Right here we've got it set at coin flip. All right, if we were to run that 100 times, what the end results might look like. Now here it's running as Mike with 4 losses in a row, and then some wins and losses and strings of wins and strings of losses. Ooh, there's a long string of losses. Okay, it's random every time, so out of a 50% probability, we ended up with 45 wins and 55 losses. So that would take $10,000 down to a low value of $1,870 and an ending amount of $22.18. Wow, not good. Well, Mike, what's usually the answer? People will look at this and say, well, geez, how could I do better than that? What's usually the answer?
I need to win more. That's a clear answer, isn't it? I need more winners.
Yeah, I need more winners. Okay, so let's run that simulation again. It's random every time, so I don't know if we'll get more winners and losers this time or not. Well, we did. Okay, we got more winners and losers. 52 winning and 48 losing trades. Over here on the right, it shows starting out with 10% loss, and then a 10% win, and then a 10% loss, and a couple of losses, and a couple of wins, and so forth. Anyway, we have 52 winners. But Mike, we took our $10,000, rolled it up at one point to 14,631. So that looks like a 46% gain. That's pretty good. But then at another point in our trading, we were biting our nails because we're down more than 30%. And finally, our ending amount is $9,038. Does that excite you? Starting out with $10,000, doing 100 trades, and ending up with $9,000?
No. I mean, yeah, sure, I only lost about 10%, but still, in the end, where's my productivity here?
Right. We'll try this, okay? Let's roll it again. Let's see if we can get more winners, okay? If we get, no, that didn't do the trick. Let's see if we get more winners. Come on, more winners. That's what we need, isn't it? That's what everybody thinks they need. Man, I'm not getting it, Mike.
There you go.
Oh, looky. Okay, we had 56 wins in this record and only 44 losses. So we took the $10,000, rolled it up at one point to $20,168. It also happens to be the high amount. Of course, during this trading career, we also had a low point of a 51% drawdown. Look at that. Wow. So we doubled our money. That's good. And we had a good trading record. Okay. But we ended up with $20,000. Okay. Now, I want everybody to remember that. Remember $20,000 with 56 wins. Okay. Now, Mike, can we really predict that we're going to win more often than we lose?
No, we cannot predict how many times we're going to win in a series of trades. That's not up to us. It's up to the market, which is essentially random, essentially rampant chaos.
Right. But you know what? Let's go up here. I'm going to take this target return and I'm going to actually adjust it. You know what, though? Instead of adjusting it upwards, I'm going to adjust it downwards. I'm going to make my returns more modest. Okay. On the other hand, I'm going to also take my loss limit down to, say, 4.5. Okay. All right. Now let's run that simulation again and see what happens. Okay. Now, Mike, with 52 wins and 48 losses, we would have taken our $10,000, pulled it up to a high value of $60,006 in this trading record. Wow. That's interesting, because we doubled our money with more wins in the other record. Do you remember that? What did we have? We had a 10% target return, not 8. We had a 10% loss limit, probability of 50%. We had 56 wins and ended up with 20 grand. Now we just had 52 wins and ended up with 60 grand. That's interesting. Did we set a higher target?
No, we lowered our target, our expectations. We lowered our expectations.
But what did we also lower?
We lowered the amount of money we would lose on each position. We lowered our risk to a manageable amount, which gives us a skew in our favor.
That's right. Mike, I'm going to show folks the Holy Grail of trade. Let's run this thing until we get more losers than winners. No, that's more winners. Let's get more losers, winners. It's random every time. Look at that. Really terrible trading record, okay? We lost 60% of the time. Only won 40% of the time. Took $10,000 and high value of 22 in the amount of $13,000. Mike, did we make money or not?
No, we made a profit. We're up 30%, aren't we, Kurt? 37%, excuse me.
Yeah, 37%. And that's to be wrong more often than right, okay? So I'm going to call that the Holy Grail of trading. It's not necessarily radioactive trading that's the Holy Grail of trading, but doing this kind of skew, that is the Holy Grail of trading. Making it so that your trading rules reflect you getting out at 8% or so, but absolutely limiting it so that your losses are very, very low. Okay, now Mike, I chose 4.5% because my own personal trading record, it's I think it's running about 3.9%. 3.9% is my average loss, and that's over the last 3 years, including the crash. Okay. Well, how is this accomplished? The way that that's accomplished is by using the radioactive profit machine structure. Okay. Here's a recently closed trade. On September 14th, 2010, I picked up shares of Altera Technologies at $27.35. At the same time, I picked up an insurance policy, Mike. Now, what's kind of funny about this? Is there something funny about this?
Well, anyone who's ever read any general information, or maybe you've read some free information at your broker when they discuss a married put or a protected put, what they'll discuss is you buy shares of stock, and at the same time, you buy a put option that's below the current stock price, and maybe only 30 to 45 days at a time. So you're only paying 80 cents or maybe $1 for the protection. And if the stock falls, well, okay, then your insurance policy will eventually kick in. And if the stock moves up, then you only paid a little bit out of it. This is completely reversed from that setup. What you did here is you actually went several months out in time instead of only 1 or 2 months, and you bought a put that was above the current stock price. It was in the money in relation to the put.
Right. That's kind of backwards, because what we're doing is we're buying a put that's far, far out in time, and at the same time, it's in the money. Well, this is what I call the 5-line setup. Here's line 3. Line 3 is my total investment amount of $30.85. Now, you had an objection when I showed this to you 3 years ago. What did you tell me, Mike?
Well, if we just look at the raw numbers, again, math doesn't always perform the way we expect it to, which we've been discussing. But if you just look at the raw numbers, I said, Kurt, you bought shares of stock at $27.35. You added a put that was over 10% higher than the cost, so you've got $30.85 invested in a stock trading at $27.35. You're not going to make a dime until the stock moves up $3.60, until it goes above $30.95. I don't see how this is going to work for you.
That's right. Okay. Now, I'm going to go ahead and handle that. Okay. But I want everybody to remember this figure, $30.85. And like Mike said, most folks believe that I won't make a dime until the stock is at $30.95. but that's not how it works. Okay. Now, Mike, along this way, I've got a guaranteed exit of $29. Why is it guaranteed? Because I have the put option. Okay. Because I have the put option, I've got something better than a stop order. I don't care about opening gaps, and I don't care about flash crashes in the middle of the day. I don't care if a tower. Well, I guess I'd care patriotically if a plane got flown into a tower. But as far as my finances go, any kind of disaster can strike, and I'm not going to lose more than the difference between my invested amount and my put option. In this case, it's $1.85, and $1.85 against the $30.85 that I put in is a 6%, kind of like a stop. I like to say, don't trade stocks, trade stops. Pretty cool.
Mm-hmm.
All right. So now we've got a radioactive profit machine set up. Okay, and if the stock decides to go up, we're going to make money. If it decides to go down, we're going to lose money, but we're not going to lose the huge amount that we could lose. I've skewed this expectation of risk and reward already.
Mm-hmm.
Now, this dash line, this break even, in the case of this particular stock, it's $30.85, right?
Yes.
Remember how the stock was $27.35 and the put was $3.50. So $30.85. That's the break-even line. Okay, and most folks believe that if the stock doesn't go to $30.95, I'm not going to make a dime. But here's the deal, Mike. This amount here that I could possibly lose, the 6% that we talked about, the only way that I'm going to lose that is if three things happen. Number one, the stock goes down. Number two, I hold this position all the way till expiration. That's 6 or 7 months. And number three, I don't make any adjustments. Okay?
Mm-hmm.
Now, am I in control of two of those three things?
Yeah, you have to satisfy several. You have to satisfy several of those, the few of those problems before realizing the maximum risk on the position.
Right. So for me to lose 6%, the stock has to go down, which I don't have any control over.
Mm-hmm.
But I also have to have made no adjustments, and I do have control over that. I do have control over whether or not I'm going to make adjustments. And then number three, I do have control over whether or not I hold it all the way till expiration. Okay? So I've put a lot of things in my control, including the maximum loss that I can possibly lose. Okay? All right, so starting from there, let's compare owning three different positions. And these are three different bullish positions. One is straight stock, one is the covered call, and one is the married put. Okay? Mike, if I own stock and the stock goes up 20%, if I sell, how much do I make?
You're going to make 20%. Straight yield.
Right. Okay. I'll make 20% in that scenario. Now, a covered call is going to kind of cap my gains, isn't it? I mean, yeah, I might make 5% in a month, but it's only 5%, right?
That's right. Unless you manage the position or put more money into the position to adjust the call, you're capped at a 5% gain.
Okay. And a married put, the expense of the put is going to cut into my profit a little bit, isn't it?
Well, sure, we have to pay for insurance. We can't get something for nothing. We're trying to insure our downside, so we're giving up a little bit of the upside profit potential.
Okay, so we're not going to do as well with the married put, but we're going to certainly do better than the covered call. And the best performer out of this whole thing is the straight stock. Okay, So let's say we take our profits because we profited in each one of these bullish positions. Okay, let's say that we take our profit and then we play a stock again, a new play. All right, so we get in and the stock goes down 20%. How much do we lose with the stock?
Well, you would have lost 20% again, a straight negative yield this time on the stock ownership.
Right. But with the covered call, we've received a little premium, so we're not going to lose as much, right?
Yeah, I mean, that's going to give us that little hedge we talked about earlier. So if the stock drops 20%, maybe we collected 5% premium, so we're only down 15%. Well, I shouldn't say only. We're down 15%, which over the long term will be disastrous.
Right. Now that's Altera position that I just showed. There's a maximum of 6%. But again, that's if I, number one, make no adjustments. Number two, hold it all the way till expiration. And number three, the stock goes down. Well, let's say the stock did go down and I didn't make an adjustment. Would you still go along with me that I'd probably be able to close the position for a little less than the maximum loss? Do you think I could get out of it with a 5% loss instead of 6?
Well, sure, because in that first month, you've only decayed about 30 days of that time premium. So your put option would still have time premium remaining, and you wouldn't realize the full loss just yet.
Right. Okay, so my maximum loss here is going to be 5% on that married put. Now, Mike, let's take a look, because this was back-to-back plays, right? We played a stock that won, and we played a stock that lost, okay?
Mm-hmm.
If the straight stock makes 20%, then loses 20%, what is our net?
Well, you'd want to say it's 0%, and we talked about that earlier with the 5, 20, and 5. Well, wouldn't that just be a 10% loss? But that's not how the math performs when you're investing, is it, Kurt?
No, not at all. In fact, if we were to take $100, for example, what would we multiply toward to show a 20% gain?
Well, we could multiply it times 1.2. And if we had $100, we multiplied it by 1.2, then that would give us our $120. That's what we'd have left after, or what we'd have in our account, excuse me, after 20% gain.
What would we multiply times to reflect a 20% loss?
Well, we take our current value and we could multiply it just by 0.8, for example, and that would give us what we'd have remaining if we had a 20% loss after on a $120 amount.
Right. This is how math really behaves. If we have a 20% gain and then a 20% loss, it's not a net of 0. It's a net loss of 4%.
Right,
All
so we
right?
started with 100,
that's one of the things.
and now we're down to 96.
Yeah. So and that doesn't include commissions, but that's a little scary. It's even worse with the covered call, okay, because we capped our gains on the way up, but we didn't really mitigate our losses by much on the way down. Okay,
Mm-hmm.
If we make 5%, we make 5%, but if we lose 15% on what's remaining, it's going to be a net 10.75% loss, and this is on the same two stocks that we were playing with the straight stock play. Okay, but let's take a look at this over the long haul. What the married put play is going to do for us is this. It's going to maybe cut into our profits a little bit, but it's going to certainly save our skin when the market goes against us. All right? So if we make 15% on the way up and lose 5% on the way down, we're going to end up with a net gain. Now, I want to point out something, Mike. All three of these were bullish plays, right?
Oh, sure. Stock, covered call, and married put are all bullish strategies.
Right. And in each case, we had the exact same stock doing the exact same thing, didn't we?
Yes. Mm-hmm.
It was the same market, but the different end results. The stock-only strategy lost us 4%. The cover call strategy lost us more. The married put strategy with the same stock and the same outcomes, okay, ended up with a gain. And the reason that most people don't buy a put option to protect their stock is because they think they're going to cut into their profits. Isn't that foolish when we look at how the numbers really play out? Okay? Here it is again, okay? The same market, different end results. If we cut our losers short and let our winners run, then we can have lasting success, okay? And that's the point, okay? So, Mike, does this fit now?
Well, yes, because the one thing
Does the saying fit?
Yeah, the one thing we, have to point out is that, okay, so we're talking about this axiom of cut your losers short and let your winners run. And the long stock position doesn't solve that for us automatically. The covered call position doesn't satisfy that for us automatically. The married put forces us into this philosophy of cutting our losers short and letting the winners run.
Right. It's kind of like putting a lock on your refrigerator door. If you're dieting, you've got to ask your wife for the combination, and guess what? She'll help you stay honest. Listen, Mike, this was the results before. 18% said, yes, I'm happy with my trading results. The other what is that, 82% said no or close to no. You know, I mean, pretty much no, but easier to say no. Easier to say than no is mixed emotions. Okay, so let's run the poll again with this added light. Okay, if you could keep your wins from last year, but all of your losses were reduced from whatever they were to 6% instead, would that have changed your answer? Would you have said, yes, I'm happy with my trading results? Would you have said no but been closer to yes? Or if you said no, would you still say no if you were practicing the type of trading that I just showed, where you keep your losers short and let your winners run? If you could keep your wins from last year, but your losses were reduced from whatever they were to just 6%, well, would that have made a difference? Okay, and Mike, the results here are remarkable. Let's give this poll another few seconds. 3, 2, 1, close. Okay. Oh, and look at that. Just at the last minute, it went to 2/3 and 1/3. It was trading 60-40 there for a while, and now it's 67 and 33. 67% would have said, yes, I'm happy with my trading results. Mike, is 67% better than 18%?
Absolutely. It's more than triple, isn't it, Kurt? Well, pretty much close to almost triple.
2/3 of our audience that participated in that poll would have done better. And then the other third would have said no but been closer to yes. Well, wait a minute. Does that mean that their trading results would have been better?
Most likely, yes. They wouldn't have suffered some of those egregious losses that one might take with a vertical spread, for example, excuse me, where one loss might wipe out 10 previous gains, or even with the covered calls. Still, if I'm covered calls trading, if I'm looking to make 3%, but I trade 10 positions and I have one of those 10 positions suffers a 24-25% decline, I was right 90% of the time and still came out of the month with a loss. And over the long term, we can see everyone would have been closer to being happier with their trading results. They just focused on the one basic principle that you've given away for free today.
Right. Now, here's the thing, folks. Okay, I'm going to go ahead and make a pitch later at the end, to buy my book. And if you've already gotten it, thank you for your business, and please use your support. Okay, if you have any question about anything, any of the 10 income methods, which I'm getting ready to show 2 of them. If you have any questions about any of the 10 income methods, why then write me at support@radioactivetrading.com and we'll clear it up for you. Okay. But folks that haven't gotten the blueprint, just so you know, I'm going to make a small pitch at the end for that product. But here's the thing. Before selling the blueprint, I want to sell you on this idea to just simply practice trading this way. Will your results look different? Well, 100% of you said yes. 100% that participated in the poll, 67% said my trading, I would have been happy with my trading from last year. And 33% said, well, I still wouldn't be satisfied, but I'd be further ahead. Okay? Pretty cool. And that's just beginning where I showed you to begin with limiting your losses down to single-digit percents. Okay, now let's move further. Okay, what if we were to take these and adjust them? Here's the reminder of how we set things up. All right, Altera shares at $27.35, the March $29 put at $3.50, and the total invested is $30.85. Now, most folks tell me that I'm not going to make a dime until what?
Until the stock's trading at $30.95, 10 cents above your total investment.
Okay, well, we're going to blow that out of the water, okay? We're starting with the 6% risk, but let's see what we can do with this, okay? The adjustments are called income methods because they're almost always done at a credit. We're going to take our stock, and now we're going to do a spread trade nested within the ownership of that stock and that put, okay? I call them income methods. Listen, folks, I'm going to show you 2 spreads that introduce 0 risk but make your position a little bit better. It's what I promised in the email. Are you all ready for that? Would you like, for example, to see a ratio call spread? Somebody said the ratio call spread is, unlimited risk. Well, guess what? I'm going to show you one that even if the stock moves sideways, you'll capture some great premium. Ron brings up, what about if the stock goes sideways? I think you're going to like income method number 5, which I call the money net. Okay, are we ready for this? Oh, yep. We're talking about the expenses here. Kurt can't make any money until the stock goes up high. Well, let's find out if that's true, okay? On September 24th, 10 days into the position, I did income method number 5. Now I'm gonna say that this is scalable. I'm showing this in terms of buying 100 shares of stock and then doing this play. But I actually bought 500 shares of stock in 5 puts, okay? So it's scalable. But so that the math is easy, let's go ahead and show it this way, Mike. We buy 1 call and sell 2 at a higher strike. I sold 2 October 29th at 85 cents. That's where it was trading for $1.70 total premium in. Now, there's a problem with that. If I have 100 shares of stock and I sell 2 calls against it, what's the problem, Mike?
Well, now you have a naked call. One of those short calls is not covered by anything, and it has an infinite upside risk. If the stock goes up, you have an infinite risk on that short call that's hanging out there without any coverage.
Right. So we're going to cover one of those by also buying a call option. Now, some folks have made the objection, hey, my broker won't let me do this. Okay, cool. What you need is a new broker. Because what I'm showing you here is safer than a covered call play, and your broker will let you do covered calls, but they won't let you do something that's safer. Well, guess what? There are brokers that will allow this kind of trade in your account, and you can roll it over. If you have an IRA, for example, you can roll it over with very little fuss and get into a broker that's going to allow you to do things that are safer than covered call trades. Well, here's the deal, Mike. If I spent $1.40, what is that? $1.45, but I also took in $1.70. What's my net?
Well, for this transaction, you're going to receive a 25-cent net credit.
Right. Okay. Now, just so we're clear, okay, the stock was trading at this point at $28.50. If the stock stays flat and it just goes to $28.50 at expiration, what happens to these $29 calls?
Well, if the stock's at $28.50 on October expiration, your 229 short calls will expire worthless. They're out of the money, so you won't have any obligation to deliver stock or close one of the short calls.
What about the long call? What about the $28 call? What will the situation be with that?
Well, it'll now be 50 cents in the money, so you'll still have a value of 50 cents on that 28 call, the 128 call.
So I capture 25 cents by doing this, and then later, if the stock is trading sideways, I'm going to capture another 50 cents, right?
That's exactly right. You're going to be able to sell to close the 28 call for 50 cents, and you kept the 25-cent net credit without having to make any adjustments.
Right. Okay, so this is why I call that the money net. Now, here's another thing to think about. Mike, if the stock goes down and everything expires, all of these October plays expire, I'm going to still keep my 25 cents, right?
That's exactly right. If it's below 28, you still keep that 25 cents. Everything expires.
And then I'll still have November, December, January, February, March. I'll still have 5 months to do other plays to take in more income. Okay, so that's kind of exciting. So here's what happened then, Mike. My total amount invested before from $30.85, okay, has now got this 25-cent credit against it. So really, my cost basis for my stock and my put is $30.60. That put is a $29 strike, so now I have $1.60 at risk instead of $1.85. With me so far?
I'm with you.
Oh, okay, good. All right, so here's what happened, Mike. On October 15th, expiration Friday, Altera is trading around $29.40. Now, those short calls were $29 calls. So if I want to close them, I've got to buy them to close, right? I've got to buy it back.
Yes, you have to close it to avoid being assigned.
Right. So if I didn't want to get my stock called away, I was going to have to do something, and in this case it was to buy to close some of those short calls. Okay? Now, check this out. It was 55 cents on the ask. Okay? Now, if you look at this, I've received 25 cents, and if I close one of the shorts for 55 cents, wouldn't that put me behind by 30 cents?
Yes, that's right. We received 25 cents for the income method number 5. Then you need to pay 55 cents out, so you'd add essentially 30 cents back into the cost basis that you had reduced it from originally.
Okay, but let's not forget something, okay? The fact is that I don't just have short calls. I bought a $28 call and sold two $29 calls. If I close one of those $29 calls, what's going to be left?
Well, you're still going to have one long 28 strike call and short a 29 call. You're essentially going to have a bull call spread if you close one of those 29 strike calls.
Yeah, that's what will still be in place. And this is an expiration Friday, and the stock is trading above $29. So that bull call spread is going to close in the money, right?
Mm-hmm, that's right.
Okay, so I've collected 25 cents to begin with, okay, and I buy back one of those calls at 55 cents. So here's how it goes, okay? I began with this 25-cent credit, okay? On October 15th, on expiration Friday, I buy to close one short call. I had received 25 cents, but I'm spending 55, so I've got a net debit of 30 cents, but I'm also left with a long $28 call and a short $29 call, and the stock is trading above 29 bucks. I've spent 30 cents so far, yes?
That's right.
Okay, I've spent 30 cents, but I've acquired a bull call spread that is in the money. It's 100% going to close in the money. Check this out. When in the middle of the night, okay, because Altera is over $29, my broker looks and sees that $28 call and says, oh, Kurt has the right to get stock at 28. Let's get it for him, and exercises my call. On the other hand, the broker looks again and says, oh, Kurt has taken on an obligation to deliver that stock at 29. So in the middle of the night, my broker buys shares at 28 and immediately sells them for 29. I don't have to do anything. It just happens in the middle of the night. And I've paid 30 cents so far to manage the spread, and I get $1 back. Pretty cool. Where I come from, that's 70 cents credit, and it's been caught in the money net. Now, here's what that makes my new position look like. Oh, by the way, if I had just done a covered call and I wanted to keep the stock, it would have been 85 cents credit, take away 55 cents to close the call, so I'd make a net premium of 30 cents instead of a net premium of 70 cents. Okay, so that's one advantage to having more than one arrow in your quiver. Instead of just knowing how to do covered calls, we like to know a lot of different things. Okay, so with 133% higher in my pocket and having the stock and the put now uncovered, I'm pretty happy. Okay, now remember, Mike, the original setup cost of this radioactive profit machine was $30.85.
Yes.
I received the credit. I paid back a little bit to manage that, okay? And so my cost basis after the buyback is $31.15, and then that bull call spread closes in the money in the middle of the night. So now my cost basis is down to $30.15 a share. Okay. Now remember, with that initial cost of $30.85, a lot of folks believe that I wouldn't make a dime until the stock was at what?
Well, $30.95, right?
Right, okay, but we're gonna show them wrong here in just a minute, okay? The new cost basis after doing my money net trade was $30.15. The income methods reduce the gap. My gap here had been 6%. Now the gap is less than 6%, okay? But I'm not finished with my income methods. Who would like to see another spread trade that introduces zero risk and at the same time collects a credit? Would you be cool with that? VK wants to see it. Okay. All right. Now most folks, again, like I said, when I shared the $30.85 cost basis. Most folks believed I wouldn't make any money until the stock got to there. But I've just shown that the stock was at $29.40, and I did this adjustment, right?
Mm-hmm.
Okay. Let me do a poll here real fast, and then I'll show that, okay? I didn't actually run this poll. When you hear a new idea that contradicts what you believed before, what do you do with that idea? Do you reject it out of hand? Are you suspicious, but you check everything out, just to be honest? Or do you investigate fully, knowing that everything that you know now, you know because you investigated further? Or do you just believe anything that everybody tells you? Okay, let's give this just a few more seconds. It's pretty overwhelming. 3, 2, 1. Close. Okay. Nobody says I'm foolish enough to reject it out of hand. And nobody says I'm foolish enough to believe anything everybody tells me. But 11% are suspicious, but you check it out, to be honest. And 89% investigate fully. Okay, well, listen. Here's an idea that contradicts something that you thought. You might have thought that I couldn't make any money until that stock was at $30.86. Well, here's the next play. We're going to call it the bulletproof vest. Mike, my put option was a March 2011 $29 put. Now, it's declined in value, hasn't it? How come?
Well, time has passed, and also the stock has moved up in price. So as the stock moves up, naturally, hey, put's going to decline in price. We're going to lose some of that intrinsic value. Absolutely right.
Right. Okay. Now, the cost of this put had been $3.50. The reason that it doesn't go down by more is because it's so far out in time. See, the put has come down 98 cents, right?
Mm-hmm.
It had been $3.50. Now it's $2.52. Okay. All right. I'm going to do a play here that I call the bulletproof vest. And what it is I'm swapping. This says STO. It should see STC. Sell to close. I sold those put options for $2.52, and in their place, I bought November $30 put options for $1.62. Now they're priced lower because November expiration is right around the corner. It's October expiration now. This is on October 15th, and I'm buying the November 2010 $30 put option. Okay, so again, do I result in a net debit or net credit?
You're going to receive a credit for this transaction. You're able to sell to close your March 29 put for $2.52, and then you're going to take $1.62 from that and change it to the November 30 strike put option.
How about that? Okay, so this 90-cent credit is going to be set against my radioactive profit machine. Okay, remember the cost basis for both the stock and put had been reduced by using the money net. It had been reduced to $30.15. Now I'm taking in another 90 cents by doing that put spread. I still have a put. It's just a different put, right?
Yes, right.
Okay. What's my net cost for this stock and put that I'm holding?
Well, now you've lowered the total investment again down to $29.25 from 30.
Okay.
Yeah, from 30.15, right?
Right. And it's a November $30 put that I'm holding. So my put strike is 30 cents. So what's my risk now?
Your risk is zero. Well, it's negative, for lack of a better term. Your total cost into the position is lower than your guaranteed exit. So you have a guaranteed return of 75 cents. In the worst case scenario, if the stock just plummets from this point on, you're guaranteed to make a profit. But if the stock goes up, you no longer have a short call, so you still have an unlimited upside with a guaranteed return on the downside.
Pretty cool. That's pretty cool. Okay, this is what we call bulletproof. Okay, when you can't possibly lose. Now, here's why I did this, Mike. The earnings announcement was due on November 2nd, and the expiration I think was like November 16th or something. So what I'm doing here is I've decided that I want to hold on to the stock through the earnings announcement, but I want to take all the risk off the table. Now, remember, the stock was trading at $29.40 when I did this. What happens to the argument that the stock had to go to $30.85 before I started to make money?
Well, my argument now looks a little bit foolish, doesn't it, Kurt?
Yeah, the argument's gone, okay? What I've done by way of the income methods is reduce the gap to less than 0. So now I'm bulletproof, okay? No way I can lose. So who says I couldn't make money unless Altera goes above $30.85? Okay, I've already locked in a 75-cent profit no matter what happens to the stock, and the stock's only at $29.40 by this time.
Mm-hmm.
Okay, so after the earnings announcement, here's what did happen, Mike. After the earnings announcement, Altera went up, and I was able to sell the shares for $33.10. So my worst possible outcome would have been 75-cent profit, but in truth, it was a $3.85 profit. Again, this is scalable. I did this on 500 shares of stock, not 100. Okay, by using the ratio call spread, income method number 5, and by using that put adjustment, which doesn't have any real name in regular options books because, well, it's just not in there. I call it the bulletproof vest. Okay, when the stock was only at $29.40, I made it so that I was bulletproof.
Right.
And ended up with a 12% profit in 6 weeks. Now, the 12% profit is not what's impressive. What's impressive is the fact that I never had more than 6% at risk. I was bulletproof before going into earnings, and I was able to ride that stock higher. Does that go along with the saying, cut your losers short and let your winners run?
Absolutely. We forced ourselves into that position, didn't we?
Exactly. I forced myself not to take on too much risk. Mike, could I be wrong more often than right and still make money with this? I mean, if I lose 6% when I'm wrong and make 12% when I'm right, could I actually be wrong more often than right and still make money?
Yeah, we already proved that with the trade simulator, didn't we? And everyone after the webinar, you can go to radioactivetrading.com and go into that resources tab, plug in those numbers, 12% gain, 6% risk. You'll see how you can be wrong more often than right and still make money.
Right. Now, I know that some folks will say, well, Kurt, what about commissions? Well, you know, what about them? That did cut into 0.1% of my earnings. Okay, so instead of 12%, it was 11.9%. Okay, but the best part of the story is this: neither of those nested spreads that I put into this play introduced any risk, but both produced a credit. Both of them I was able to do for money. Okay, but neither one hurt me. Neither one introduced any risk at all. Pretty cool. All right.
Pretty cool.
Now let's open it up to questions because we said we would, and we'll take a couple of questions, and then put out the blueprint offer, and then we should be done.
Well, we discussed Ron's question about what about sideways. Hey, there are 10 different income methods, and the way that I look at it is that when I open an RPM originally, well, let me just go back one step, Kurt. I apologize. In those 3 scenarios that you had, if it's a sideways market, let's just say stagnating completely, with the stock you have no gain unless it pays a dividend, but really the stock you have no gain. In the covered call trade, well, the call would expire, assuming you were at or slightly out of the money to begin with, so the call would expire and you'd lower your cost basis. Now with the married put, the RPM by itself, some of that time value over the first 30 days in a stagnant market is going to decay out. So maybe you could still liquidate for only a minus 0.5 or minus 1% loss at the most after the time value decay in the first 30 days. But that's where the income methods come in. If it's a stagnant market, I might look at income method number 5 or income method number 6, really income method number 8. If it's a bullish market, I'll look at income method number 1. I'll look at income method number 3 perhaps that we just saw. Income method number 4, income method number 6 as well. And in a declining market, well, you can follow income method number 6 or even income method number 9.
Right.
So there are different approaches there.
We got a question. Yeah, we got a question that what income method would you use for a stock that dropped significantly right after you bought it? Well, there's differing opinions on this. You could use what we call income method number 9,
Mm-hmm.
It'll increase your risk a little bit, but it'll also increase your chances of the stock working out. But you know what? What if you just closed it? I mean, what if you just took your lumps and instead of, if the stock went down significantly, as the caller is asking, well, why not just get out of it with your 4 or 5% loss and move on? You know, you don't have to get emotionally attached to any stock. Okay.
Mm-hmm.
All right. Another question. Do you still have a stock repair tool?
That's
I
on
don't know how
power.
to handle that question. I think
I
that's
do.
That's a power options question.
It's
okay.
The stock,
Go ahead.
the stock repair tool is still available on power options, but wouldn't it be better to be in a strategy where you didn't need the stock repair tool to begin with?
Right.
To have limited risk in the first place. But yes, the stock repair tool, what it shows you is that kind of ratio spread that you were looking at, Kurt, to help you get back to break even if the stock has fallen. Well, if you already had protection in place and limited risk, well, then you could apply income method number 5 and not have to worry about trying to repair the stock, just catching more money in the money net from a limited risk position you already have.
That's right. Income methods number 5 and 6 are called the money nets, and they will collect money regardless of the direction of the stock.
Mm-hmm.
Joe says, when you bought the 2 short calls, oh, hi, Joe. This is a Joe that I know. When you bought the 2 short calls against the 1, was margin required? Joe,
No.
Here's how it went. Okay, I sold 2 calls against 1 long call and 100 shares of stock. In truth, it was I bought 5 calls and sold 10. Okay, but 5 of those short calls were sold against the stock, and 5 of them were sold against a long call. Is margin required? No. No, it's not. Because I've got a limited loss. In fact, there's really no possible loss in that play.
Yeah, another way of looking at it.
If the stock goes down, I've received a credit. Go ahead.
I'm sorry. I was just going to say another way to look at it, Joe, is you had long shares of stock and a protective put in place. Essentially what you did is you entered in a covered call by selling 5 contracts against your 500 shares of stock, and at the same time did a bull call debit spread that you actually got paid to do. So nothing was naked. Nothing was left open without margin. It's just a bull call debit spread where you don't need margin for, and a covered call.
Right. Here's a question that I anticipated, so I put some slides to it. Okay. So regarding that put option, the original put option was $3.50 in cost. Right. You see that represented here. Part of it is intrinsic value, and part of it is time value. Now, as the stock went up, okay, the intrinsic value goes down, correct?
That's exactly right.
Dollar for dollar. Yeah, that's dollar for dollar. As the intrinsic value goes down, the intrinsic value was $1.65, okay, because time value was $1.85, right? And the intrinsic value is $1.65 for a total of $3.50. As the stock goes up, it becomes all time value. But Mike, if you look at just the time value itself increased. That's a phenomenon that I document in the blueprint called the ATM bell curve, at the money bell curve. Okay? Interestingly enough, the time value, even though time has passed, the time value went up. Why? Because the time value component was just a portion of that put. Now, there's no longer any intrinsic value, so it's completely time value. A lot of folks don't get that at first glance, but that's the secret behind income methods number 3 and 4 and how they lock in a higher gain or they take a credit or both. Okay? All right, other questions?
There's a good question that came in from.
Go ahead.
There's a good question that came in from Samuel. He wanted to know, how do you identify stock positions with your program? Well, I think actually I'll talk to Samuel later. But tonight at 9 p.m., we're having a special presentation on using the Power Options search tools to identify RPMs. Now, it's not direct advice on what you should always do, but it's going to get you familiar with the program on what you might want to use to select those RPMs. And you can register for that webinar right on the site on RadioActiveTrading.com.
That's right. Mike, I was a client of Power Options before I partnered with y'all, and I would not even think of doing this kind of trading without the Power Options tools, because it does all the heavy lifting for me.
Mm-hmm.
I used to pour over options tables and look at the right mixture of, search for the right mixture of a put option plus a stock in order to keep my risk around 5-6%. And now I just press a couple of keys and I get 100 different stocks to choose from that fit my criteria, and then I get to go in and look at their charts and so forth. It's amazing, and it happens in seconds. I would not trade that for the $59 a month it costs for Power Options.
Mm-hmm.
Okay. All right, Mike. Let's do that offer, because I think folks have got to go. I put up the slide there that we didn't need to really look at. So here's the deal: what you get, what it'll cost, and what you risk. All things that are important. Okay. What you get with the blueprint is over 250 pages of instruction on limited risk but high potential return trading. You also get all 10 income method adjustments. We showed 2 of them today. And then 3 bonuses. The quick action guide, Foundations of Radioactive Trading CD. At the end of the month, we were doing 2 free months of Power Options. That promotion is over, but we're still doing a free month of Power Options. Okay? So it's a real good deal. What it'll cost, it's $339 plus shipping. Okay? And what if the investment were a married put? Okay? What if it was? It'd be $339 is the most you could possibly lose, right? If you got the book and you said, my gosh, this is no good, I can't believe it. Why did I spend $339? But the fact that we're offering a money back, 100% money back guarantee, the guarantee takes out all the risk. Okay, so you're bulletproof from the get-go. You have 0 at risk. Okay, so what it costs, what you get, and what you risk. What you risk is nothing. Okay, so if you haven't picked up the blueprint, there's no reason not to. You get the 100% money-back guarantee, and you can keep the bonuses, including the Power Options subscription that, look, if you don't want to trade married puts or you don't want to trade them the way I do, well, there's 23 other strategies, including iron condors, and butterflies, and covered calls trading, in anything that you're into with options. The Power Options platform is the best available, and it's free with your purchase of the blueprint. Okay?
For the first 30 days.
Okay. That's right. And also free coaching with you, right?
That's correct. Any trial member or subscriber can register for free coaching sessions. These are essentially 40 to 50-minute conversations with myself or Ernie. If something has come up and I'm not available, usually I'm available. I can't give you any direct advice on your positions, but we'll walk you through the tools on the site and answer any questions that you have. And just to be clear on something, I won't answer specific questions during one of those coaching sessions on the radioactive trading income methods, or should you do this income method or that income method, unless you purchase the blueprint. We have to be fair here to our blueprint owners.
That's right. Okay. All right. I'm sending out a link to the audience. If you go to RadioActiveTrading.com and hit the products tab, you can pick up the blueprint, and there are some other products on there too. Okay. All right, and listen, folks, if you read the first 3 chapters of the blueprint, you don't feel like I've given you the means to pay for the whole purchase price, I demand that you send it back. I demand it. Send it back for a quick, no-hassle refund. I'm going to do a final poll here, Mike, and here's the deal. Do you remember this one when we saw 67% would have said, yes, I'm happy with my trading, and 33% would have said, well, I'm happier? Okay, I'm just going to ask by how much? By how much? How much would you say you would have done better? Did you miss it completely? Would you have saved at least $300 on your worst investment last year? Would you be ahead by $1,000 to $5,000? Would you have saved or made $5,000 or more? Could you have had minimal losses and bought at the bottom? Or did you maybe miss the point completely? Would you say something like, I can't see how this would help anyone? I can't see how forcing myself not to risk too much would be profitable. Okay. Let's close that poll and share the results. And bingo. Okay, 4% didn't get it, and that's okay. I didn't get it the first time that I saw this idea either. 16% would have saved at least $300, so there's your cost of the blueprints, or close to it. 40% would be ahead by $1,000 to $5,000 just with the free knowledge that we give away today, and then 40% more would have saved or made $5,000 last year. Well, okay, so there's your value, your risk to your reward. Okay, Mike, I think we're going to need to wrap it up. Do you have anything to add or subtract?
No, I think we've got everything taken care of. If you have other questions that did not get handled because we are well over time here, please send us an email to support@radioactivetrading.com, and we'll be more than happy to handle your questions there and take care of everything.
Very good. Mike, thanks for joining me, and thanks everybody that's still online. Appreciate you being here, and want to help you with your continued success in trading. We'll see you back here again on Thursday, I hope, and talk to you then. Happy trading, and goodbye for now.